Okay, so you want to own a nursing home. A steady stream of residents who need care every single day, government checks arriving like clockwork every month. Real estate that never really goes out of demand because an aging population just keeps growing. That is the pitch. That is what makes this industry look like one of the safest, most recession-proof businesses in America. Here is what actually happens. Some nursing homes operate on margins so thin that a single bad month can wipe out an entire year of profit. Others have been swallowed by private equity firms, stripped of cash through complicated lease structures, and pushed into bankruptcy while residents were still living inside the building. Today we are going inside the real economics of one of the most misunderstood, most regulated, and most financially fragile industries most people will interact with at some point in their lives, whether they realize it or not. Let's start with the scale of this. According to the Centers for Medicare and Medicaid Services, there are more than 15,000 certified nursing homes operating in the United States, housing well over 1 million residents on any given day. This is not a niche business. It is a massive, essential piece of American healthcare infrastructure. And yet, according to industry data compiled by the American Healthcare Association, the average operating margin across the sector sits in the low single digits, often between 1% and 3%. Compare that to almost any other healthcare real estate category, and you start to understand why so many nursing homes exist on a financial knife edge. To understand why margins are so thin, you have to understand who is actually paying the bill, because it is almost never the resident writing a personal check. There are essentially three payers in this business, and they behave completely differently. The first is Medicaid. According to CMS data, Medicaid covers approximately 6 in 10 nursing home residents nationwide, making it by far the largest single payer in the industry. But Medicaid reimbursement rates are set by individual states, and in the majority of states, those rates fall below the actual cost of providing care. Multiple state-level cost studies have found Medicaid shortfalls ranging from $20 to over $75 per resident per day, depending on the state. A facility that is majority Medicaid is essentially providing care at a structural loss on the majority of its beds, every single day, by design. The second payer is Medicare. Medicare does not cover long-term custodial care at all. It only covers short-term skilled nursing and rehabilitation stays, typically capped at 100 days following a qualifying hospital stay. But Medicare reimbursement rates are dramatically higher than Medicaid, sometimes 2 to 3 times higher per resident day. This is why so many nursing homes have quietly restructured themselves around short-stay rehabilitation, chasing Medicare patients recovering from hip replacements and strokes, rather than long-term residents, because the math on a Medicare bed and the math on a Medicaid bed are not remotely comparable. The third payer is private pay. Residents or families paying directly out of pocket, sometimes with the help of private long-term care insurance. According to the Genworth Cost of Care Survey, the median annual cost of a private room in a nursing home in the United States now exceeds $116,000 a year. Private pay residents generate the highest margin in the building, by a significant margin, which is exactly why the most profitable nursing homes fight hard to keep their private pay percentage as high as possible. Beyond the core per diem payments, sophisticated operators layer in several additional revenue streams. The first is memory care. Specialized dementia and Alzheimer's units command a premium per diem rate, often 20 to 40% higher than standard skilled nursing rates, because of the additional staffing ratios and specialized programming required, and demand for these units has grown steadily as the population ages. The second is in-house therapy services. Physical, occupational, and speech therapy, billed separately from the room rate, can generate substantial margin, particularly for Medicare short-stay rehabilitation patients, where therapy minutes delivered directly influence the reimbursement tier the facility qualifies for. The third is pharmacy consulting and ancillary medical services, where facilities contract with or operate their own institutional pharmacy relationships, capturing margin on medication management that would otherwise flow entirely to an outside vendor. The fourth is private pay ancillary charges, cable television, private rooms, specialized dietary requests, beauty and barber services, transportation, small line items individually but meaningful in aggregate across a 100-bed facility over a full year. Now let's talk about where the money actually goes, because this is where nursing homes are fundamentally different from almost any other real estate business. Labor. According to ACA data, payroll and benefits typically consume somewhere between 60 and 70% of total operating revenue in a skilled nursing facility. That is a staggering share for any business to carry. This isn't discretionary staffing either. Certified nursing assistants, licensed practical nurses, and registered nurses are providing hands-on medical and personal care around the clock, every single day of the year, regardless of how many beds are filled. In 2024, the Centers for Medicare and Medicaid Services finalized a federal minimum staffing rule, requiring facilities to provide a set number of nursing hours per resident per day, a mandate that, if fully implemented, industry groups estimate could require thousands of additional nursing homes to hire staff they currently cannot find or afford. And turnover makes this worse. Multiple industry studies have documented certified nursing assistant turnover rates exceeding 50% annually in the sector, meaning the average nursing home is constantly recruiting, onboarding, and retraining just to stay fully staffed. Every departure costs real money in overtime, agency staffing premiums, and lost productivity before a replacement is even fully trained. Here is the part almost nobody outside the industry understands, and it is strikingly similar to how luxury hotels are structured. In a huge share of the nursing home industry, the company that owns the building and the company that operates the facility are two completely different entities. Real estate investment trusts specializing in healthcare properties, companies like Omega Healthcare Investors and Ventas, own thousands of nursing home buildings across the country. They do not run the facilities. They lease the buildings to operating companies under long-term contracts, collecting rent whether the beds are full or empty. The operator handles staffing, care, regulatory compliance, and the day-to-day chaos of running a facility. The landlord collects a fixed, contractual rent check regardless. This split creates a structural risk that has taken down entire chains. When an operator signs a lease with rent payments calibrated to a period of high occupancy and generous reimbursement, and then occupancy drops, or reimbursement rates get cut, the rent does not drop with it. The landlord still expects the same check. There is no better case study for this than what happened to HCR ManorCare, once one of the largest nursing home chains in the United States. In 2011, ManorCare was owned by the private equity giant Carlyle Group. Carlyle arranged what is known as a sale-leaseback, selling the real estate underneath hundreds of ManorCare facilities to a healthcare REIT for billions of dollars in cash, while ManorCare, now a tenant instead of an owner, agreed to pay roughly $470 million a year in rent to keep operating in the same buildings. For a while this worked. Carlyle had extracted a massive cash return from the transaction. But the rent obligation did not care about what came next. Medicare reimbursement policy tightened in the years that followed, cutting into the high-margin rehabilitation revenue that had been propping up the business. Occupancy softened, revenue fell, the fixed rent did not. By 2018, HCR ManorCare filed for bankruptcy, unable to keep servicing hundreds of millions of dollars in annual lease payments against a shrinking revenue base. The REIT that owned the buildings took control of the operating company. Thousands of employees and residents were suddenly part of a company in Chapter 11, not because the care being provided had failed, but because a financial structure built years earlier to extract value from the real estate had left no cushion for the business to absorb a downturn. HCR ManorCare is not an isolated case. It is a pattern researchers have studied directly. A widely cited study published through the National Bureau of Economic Research examined nursing homes acquired by private equity firms and found measurable increases in short-term mortality among residents at those facilities, alongside declines in the kind of frontline staffing hours that keep residents safe and comfortable. The researchers linked the pattern to exactly the dynamic we just walked through. Financial engineering, including sale-leaseback structures and management fees flowing back to the private equity owner, extracting cash from facilities in ways that left less available for direct patient care. This is the uncomfortable core of the nursing home business. The same financial techniques that make hotel and commercial real estate ownership profitable, separating the building from the operating business, using leverage, extracting cash through fees and rent, carry very different consequences when the asset in question is where medically fragile human beings are living around the clock. HCR ManorCare is not the only cautionary tale in this space. Genesis Healthcare, once one of the largest nursing home operators in the country, with hundreds of facilities across multiple states, spent years carrying billions of dollars in debt and lease obligations tied to an aggressive growth strategy built through acquisitions. By 2021, the company's stock had fallen so far that it was delisted from the New York Stock Exchange, trading for pennies, weighed down by exactly the same structural pressures we've been describing: fixed lease and debt obligations that did not flex when reimbursement rates tightened and occupancy softened. Genesis avoided a full bankruptcy filing that ManorCare did not, but its near collapse became another widely cited example of how quickly scale and leverage can turn into fragility in this industry. There is another cost line that has exploded in recent years and rarely gets discussed outside the industry: liability insurance. In states like Florida and Texas, general and professional liability insurance premiums for skilled nursing facilities have risen so sharply that some smaller operators report their insurance costs are now among the largest line items in their entire budget, in some cases running into the thousands of dollars per bed per year. A wave of litigation tied to care quality, staffing shortfalls, and injury claims has made underwriting nursing homes in certain states so risky that some insurers have simply stopped writing new policies in the sector altogether, forcing facilities into surplus lines markets with dramatically higher premiums. On the other side of the ledger, there is a factor that protects existing operators from unlimited competition: certificate of need laws. Roughly 35 states still require a certificate of need, a formal government approval, before a new nursing home can be built or an existing facility can add beds. Supporters argue this prevents oversupply and keeps existing facilities financially viable. Critics argue it functions as a government-enforced barrier to entry that protects incumbent operators from competition, similar in spirit to how a limited number of casino or liquor licenses artificially caps supply in other industries we've covered. Either way, the practical effect is the same. In most states, you cannot simply decide to build a new nursing home and start competing. You need government permission first, and that permission is not guaranteed. Like a hotel room, a nursing home bed is a perishable product. An empty bed tonight cannot be sold again tomorrow to make up the lost revenue. Nationally, nursing home occupancy has never fully recovered from the pandemic. Industry tracking from the National Investment Center for Seniors Housing and Care showed occupancy across the sector falling from roughly 80% before the pandemic to the high 60s during its worst stretch, with a slow multi-year climb back that in many markets still hasn't returned to pre-pandemic levels. Every percentage point of occupancy below break-even is not a small loss. Given how much of the cost structure, staffing, rent, insurance, is fixed regardless of how many beds are filled, occupancy is the single number that determines whether a facility is profitable or hemorrhaging money. So let's run the actual numbers the way an operator has to. Take a 100-bed skilled nursing facility. In a strong year, it runs at 88% occupancy. Its payer mix skews favorably. 20% of resident days are Medicare, reimbursed around $550 a day. 15% are private pay, averaging around $320 a day, and the remaining 65% are Medicaid, reimbursed around $250 a day. Blended, that generates roughly $9.5 million in annual revenue. Labor consumes about 65% of that, roughly $6.2 million. Rent or debt service on the real estate runs another $1.2 million. Insurance, food, utilities, supplies, and regulatory compliance add another $1.6 million. You set aside a reserve for future furniture and equipment replacement, required under the management agreement. Net cash in a strong year comes to approximately $500,000, a genuinely good year in this industry, on a facility generating nearly $10 million in revenue. Now the bad year. Occupancy drops to 70%, partly from a slow post-pandemic recovery, partly from a staffing shortage that forces the facility to turn away new admissions because it cannot safely staff more beds. Payer mix worsens too, because private pay families are more likely to shop around when a facility's reputation takes a hit, while Medicaid residents, once admitted, tend to stay. Revenue falls to roughly $6.8 million, but labor costs do not fall proportionally because minimum staffing ratios and the need for experienced nurses on every shift mean you cannot simply cut headcount to match a lower census. Rent and insurance do not move at all. The facility posts an operating loss for the year, and if that facility happens to be leasing its building from a REIT under a fixed long-term lease, exactly like HCR ManorCare, there is no flexibility to renegotiate quickly enough to avoid a genuine solvency crisis. Here is the sentence that actually explains this entire industry. A nursing home is not really a real estate business or a healthcare business. It is a labor-intensive, thinly margined operation sitting on top of government reimbursement rates it does not control, insurance costs it cannot predict, and, in a large share of cases, a real estate lease it cannot renegotiate the moment things go wrong. The demand for this industry is not going anywhere. America is aging, and someone has to provide this care. But the operators who survive long-term are not the ones chasing the fastest expansion or the most aggressive sale-leaseback deal. They are the ones who kept enough margin in reserve, kept their payer mix diversified, and never let the financial engineering outrun the actual cost of caring for the people living inside the building.